Good evening, everyone. Thanks,
Good evening.
thanks for joining the today's webinar. And before I start, I would request all of you to please stop your video and audio since it's a webinar. So the topic for the today's webinar is how to spot a major stock market top. So before I proceed with the topic today, I would like to describe what is a market top. Basically, market top is topping for any particular commodity, any stock or anything is like when there is a inflection point for trend reversal. So it's like the stock market can go to a point, make an all-time high, Nifty can make an all-time high, and suddenly you might see that the trend is getting reversed, and the stock and Nifty might reverse its trend from there. So today we will discuss what are the few indicators which can actually help you in identifying whether you are entering a market top or whether there can be a trend reversal or not. So that is the topic, that is the basic thing which we will be discussing in today's webinar. So this is a disclaimer which says that any examples which we will be showing today should not be taken as our investment recommendation, and all information is intended for educational purposes only and in no way should be considered as our investment advice. So we all know that the market has again come back to rally to confirm the uptrend last Friday, and after the BJP elections, the market has been very smooth, and Nifty has touched all-time highs. Even today, on an intraday basis, markets were touched an all-time high. Nifty is trading above 10,500, and Sensex is also trading above 34K mark. So since we last met, Sensex has gained almost 3%. And Nifty has gained 2.35%, and the market seems to be at the starting of the December it was very volatile. The investors were not taking positions in the anticipation of Gujarat elections, but as and when the results got declared, we have seen how smooth the market is going, and even the mid cap and small cap indices, they are advancing strongly towards their all-time highs. And even I request all of you to please turn off your videos. It's disturbing for the others who have joined. Yeah, so mid cap and small cap indices are marching strongly towards their all-time highs, and we anticipate from here the market will stay in confirmed uptrend for until till budget, which could be a major trigger. Until now, it seems that market will be smooth, and it is the best time to buy any stocks, as we all know. And so any stocks which is fundamentally and technically strong and is breaking out of a sound based pattern, as we discussed in our previous webinars, we should not hesitate in taking the positions in those stocks. Okay, so today we will be discussing why do we need to spot market tops. What is the reason to identify the market tops? While discussing the market tops, we will come across, and you must have also read in our commentaries that we talk about distribution day counts every day. We talk about leading stocks. We talk about low quality, high quality stocks. So we'll discuss in details what all these terminologies mean. And the most important thing is the distribution day count, which will help us in identifying the market tops. So this is again a very important thing which we're gonna discuss today. And at last we will discuss, after we discuss how do we identify the market tops, we will discuss how we can protect ourselves when a market is topping or when it is near to any top. How do we identify that inflection point well in advance to save our hard-earned money? So there is a quote from William O'Neill, and which says that you absolutely must have a pre-reliable method to accurately determine whether you are in a bull or a bear market. And this is the most important lesson you can learn if you want to stop losing and start winning. So Exactly. We all, everyone of us, whether be it investing in any asset classes, we always want to identify well in advance whether what gonna happen in future. But the thing is it that easy to identify well in advance? So actually, it is not. It's not 100%. Uh, I mean, you cannot identify anything with 100% with 100% accuracy. But there are some leading indicators. If you just note those, you can definitely increase the accuracy of identifying anything well in advance. Again, I request to kindly turn off your videos as it's a webinar, so webcam is not required. So let's discuss the first part of the today's webinar, where we will discuss why you need to spot market tops. Because we all know that when market goes into downtrend, 3 out of 4 stocks go down with it. And William O'Neill, he has said in many of his book also, How to Make Money in Stocks, that uh, it's very difficult to outperform a bear. So it's important that when the market is into correction or into downtrend, we just strictly follow the 8% stop loss rule and don't try to outperform the bear, because we never you never know how low the market can go. Where will be that dip which you are looking for to enter any to enter or to buy any stock. So when the market is into downtrend, out of the 4 stocks will follow the trend. And by systematically spotting the market tops, we can lock in gains and avoid big losses when market enters correction. Obviously, when you are identifying somewhere around uptrend under pressure that market can go into correction, it helps, because like if you would have seen our attitude when the market was in uptrend under pressure, you were not getting a lot of stock ideas. We were very conservative in giving any buy calls. We were restricting ourselves to those stocks which are technically and fundamentally exceptional, which are showing some outstanding growth story. We were only giving recommendations on those stocks. And while coming down to the selling, we were strictly giving sell calls on the stocks which has hit around 7 to 8% from your buy point, from our buy point. And on the profit booking range, we were strictly following 20 to 25% profit booking rule. So by systematically spotting the market tops, we can actually lock in gains which we have made. The notional profits, we can convert it into pay, I mean the actual profits. So this is the reason why we need to identify the market tops. And with our app, with MarketSmith India app, it is very easy to identify the market top, because when you just go into the home page of our app, you will see the status which is here. Like here you will see what's the current status. Like if you just go today and see the home tab of our MSI app, you will see confirmed uptrend, and which says that the market's current condition is positive for new buys, perfect time to buy leading stocks coming out of sound chart patterns. So in our previous webinars, we have discussed about sound chart patterns, about the leading, what are the stocks which are market leaders, how you can identify those. And we also do send emails and notifications about the change in market status. Like last Friday, you must have received an email from us and also a teaser that we are changing the market status from uptrend under pressure to confirmed uptrend. So this is an example which shows how, if you are with us, if you are a subscriber, if you are a follower of a William O'Neill or MarketSmith India app, how you could actually identify well in advance with us whether market is going into uptrend under pressure or correction. So here is a chart. So this is a market top, where we alert our users that the market might go into a downtrend. And markets actually, if you see here, the market made a top here at 6,357. This is a chart of 2008 Nifty chart. And after making a top of 6,357, the market actually went into a correction in 2008. So this is a classic example of where of a market topping out and how you can identify it. So before that, indicators are the distribution. The main indicators of identifying a top market direction is distribution day. And going forward, now I will discuss what those distribution days are. For the timing, let's just focus on this chart. So this is another inflection point where we gave a signal to our users that market is going into a rally, and we should start buying the stocks. So basically, if so, what I mean to say is, say this is the point where which was one of the inflection point for getting for market going into correction. And again, from correction, when market condition is improving and market is going into uptrend, I mean it's making a rally attempt or going into a rally, this again here we are alerting our users that the market is again going into the new uptrend. So when you get this kind of a notification, when you get this signal that market is getting into uptrend, you know that right your approach should be to buy the stocks, because uptrend is the best time to buy any stock. Now again at 6,338 market, we again alerted our users that market is might make a new downtrend, and market actually made a downtrend over here. Somewhere over here again we would have alerted about a new uptrend. So this is how we, based on our methodology, based on distribution day counts, and based on a lot of other factors, other calculations which we follow, we alert our users about a change in market direction. And someone who is using our app for the last 6 months must have observed that 2 to 3 times we have changed the market status to uptrend under pressure and back to confirmed uptrend. And actually, when the market was in uptrend under pressure, it was very volatile. A lot of stocks were making double bottom base pattern. Normally a double bottom is made when the markets are very volatile. So, and market was actually in uptrend under pressure. So all those things we determine based on distribution day. Now coming into this slide, I'll talk about distribution days. So distribution day is when any of the major market index, in India we will talk about Nifty. So say for example, Nifty closes down today by more than when Nifty closed today falling more than 0.2%, 0.2% or more, and the volumes were higher than the previous day's trading session. For example, let's consider today only, and say for example Nifty today closed by have made a loss of 0.25%, and the volumes were higher than last trading session. So last trading session was Friday for us. So Nifty fell by more than 0.2% on an increased volume. So this will actually increase a distribution day count. This calls for a distribution day count. This is a distribution day because people were selling the stock, the investors were selling the stock on a very high volume. People were not willing to buy the stocks on that particular day. So if you get 5 or 6 distribution days over any 5-week span, the general market always turns down. So it is like in a 5-week span means you have almost 25 trading session, and in 25 trading session, if you get a 5 to 6 distribution days, provided the market is also more than 4 to 5% of its all-time highs. So if these kind of a scenario exists, then be rest assured that the market might get into a downtrend. So this is a chart of Nifty from September to December 2016. So this one is a first distribution day after a long uptrend. The market was into an uptrend, and suddenly here the markets fell by more than 0.2%. And if you see the volumes, this red horizontal line is the average. It's the average, and anything above this is above average. So market actually fell by more than 0.2%, and the volumes were above average. So this will be counted as a distribution day 1. So point 2 explains that index gaps down and marks second. In point 2, the index, this actually marks the second distribution day. It almost touched the average volume, and it is more than the previous day's trading volume. If you see point number 2, this is more than previous day's trading volume. So this will be called as distribution day 2. Sorry, this one will be called as distribution day 2. in here, if you see, the index rebounds but distribution day count increases to 3, because again the trading volume was higher than previous days trading volume. So it adds one more distribution day, and the total distribution day count is 3 till now. Now at point 4, when we are at this point, the index actually breached the 50-day moving average. And as just mentioned in while explaining the previous slide, that when distribution day count is increasing and index is also breaching its 50-day moving average, or coming 4 to 5% down of its all-time highs, then it calls for a alarming signal, and you should be worry of the market condition. So day 4 means that index breaches the 50 DMA on heavy volumes and marks fourth distribution day. At point 5, there is a gap down, and gap down is again a very bearish signal, as the gap up is a very bullish. When a stock is, we have discussed in our previous webinar that whenever a stock breaks out of any base pattern by a gap up, let's say if the stock opens 20% up, and those kind of stocks are a very bullish signal, like it happened with Titan. So similarly, when index or any stock is opening gap down and on a very high volume, that means that it is a bearish signal. So this gap down, which again the volumes were higher than previous day's trading session. So this is what we are talking about, and this, if you see this candle, it is more than this candle, so it calls for again a distribution day. So what we are having 5 distribution day in a span of just 25 trading sessions, and Nifty has also breached its 50-day moving average. So this is an alarming signal. Let's see what happens. Then we have a stalling day. Stalling day here means that when the when there is a very low price movement on a higher volume. So if you see here, the price movement is there, but then on a higher volume. So price movement is very low. If you see this red candle and this blue candle, it's almost negligible, but then volumes are higher compared to previous days trading session. And these kind of stalling days are normally seen when the market is ending its uptrend or ending its rally. These kind of stalling days will be seen. And if you are following our market commentary, we do mention about stalling days, distribution days on a regular basis. On every day in our pre and post market commentary, we do mention about the distribution day count. So if you are reading those commentaries, you will be on top of the distribution day count. So now we'll talk about some other indicators of a market top. So leading stocks are actually will give you a clear idea about the overall direction of the market, because when market leaders are showing weakness, that means that overall market is not far behind. Let's take an example of Maruti Suzuki. So if you see Maruti Suzuki, the stock clearly tracks the index. So you track Sensex and index, Sensex and Nifty, sorry. So if you see that whenever Nifty is falling by 0.34%, even Maruti is kind of falling in line with Nifty. So those kind of stocks which are market leaders, they clearly give an indicator that there is a weakness in the market, and you should take it. You should consider when you see market leaders not doing well for a consistent period of time, and on the other hand, market the distribution day count is also increasing, and market the Nifty is breaching its 50-day moving average, or falling 4 to 5% from its all-time highs. This means that the condition is not good, and you should be on top of your investment, knowing that you should be selling the stocks, strictly following that 8% stop loss. On the upside, when the stock has reached 20 to 25%, keep on selling the stocks. Don't hold on to your positions, because ultimately you might see the stocks in which you are having 20 to 25% might get eroded. So the best strategy at that particular point of time would be to be on top of the distribution day count, and based on that you take your investment decisions. So some of the other signs of weaknesses are, if leading stocks are in third and fourth stage basis, uptrend could be running out of steam. So again, this is a weakness, and that is why if a lot of you question sometimes that, say for example, like Minda Industries, it is right now trading at fifth or sixth stage basis. So those kind of stocks, though Minda is doing good right now, but then again it is trading at a very high stage base, and it is very risky to enter that stock at this particular point of time. And because normally third and fourth stage basis means the stock has had a good rally until and unless the bases are being reset. So it's very risky to enter the stock. So this late stage basis is another sign of weakness. And second thing is the climax run. Climax runs in leading stocks may be a sign party is ending. So climax stop we have discussed in our previous webinars also. When the climax runs are when the stock is kind of topping out, we have shown in few of the charts before how does a climax top looks like. So even climax top is a sign of weakness, be it for Nifty, be it for any stock. So this is a classic example of a later stage basis where after third, fourth or fifth stage base, the stock has made a downtrend. And if you see here, so these are some of the bases. These are late stage bases where after breaking out, the stock actually went on to make a downtrend. So the best time to buy any stock is when the stock is in the first stage or a second stage, because normally these are the early periods of rally, and if you are buying any stock in the first or second stage, then you will be a part of a big rally. But then if you are buying any stock in the fourth or fifth stage, that means that the stock has had most of its run, and you are entering too late into the stock. So that is why it's not recommended that you enter into any stock which is trading at a fourth or fifth stage, because a downtrend, because it's a sign of a weakness, and a downtrend can continue anytime. So the takeaway from this slide is beware of late stage basis. Best to buy a stock in its first or second stage base. Third stage basis can work, but chances of failure increases. And fourth stage bases have high probability of failure, so it's best to avoid them. So this is a example of climax run. This is a chart of Gati Limited on the chart is of 18th November 2014, and let's see the checklist. So first, the stock goes up 25% to 50% in 1 to 3 weeks after advancing significantly from its original base over many months, usually at least 18 weeks from the first or second stage base and 12 weeks or more from later stage base. If you see here, this is what we are talking about. Stock goes up 25% in 1 to 3 weeks. Now suddenly the stock will have a huge rally. So in just 7 days, the stock gave a return of 65%. So this might sound good that stock has given a return of 65% in a very short span of time, but again it calls for a alarm that there might be a topping. The stock might be topping out, and again there might be a trend reversal. So these kind of things are very dangerous, and you should be monitoring it very carefully. So closes closes excessively, if you see more than 100% above 200-day moving average. So more than, like, the stock is trading 100% above its 200-day moving average, widest weekly price spread since breakout. So all those things, gapping up, those kind of signals, exhaustion gap, these things are a clear cut signal of a weakness. So if you see here, when the stock, there was an inflection point here, and the stock actually went into a downtrend, and it never again, and it never reached to its all-time high again. So this is a classic example of climax run. So the stock was trading at 175% above its 200-day moving average, which is very abnormal. So these are the abnormalities we were talking about. Some stocks showing some abnormal returns, because none of the stock can go on forever. Be it any good quality stock, there will be some profit booking in between, and there will be some consolidation. So when those happens, so the stock's trend also get changes sometimes, and the stock goes into a downtrend. So same applies for the market also, for the Nifty, for the Sensex. When we are talking about distribution day count, by just calculating the distribution day and adding those distribution day, we come across a kind of indicator that the market status might change. So that is why it's really important to check these kind of things. Like, I'll take you back to the signs of weakness. The first one is late stage basis and the second one is climax run. So these are the late stage basis, fourth and fifth, and the climax top. This is an example of climax top. The stock is topping out. The daily price run up will be 25 to 50% in just few days. Here it was 65% in 7 days. The stock will trade more than 100% above its 200-day moving average, which is again a crazy and abnormal condition, because that kind of a rally calls for a, I mean, it's highly indicative of a topping out. Now we'll talk about some other indicators of a market top. So some other indicators are low quality stock leading the market. So watch out if the stocks that led current uptrend falter. So it's like some of the stocks which are actually not of a good quality, but suddenly you see those stocks running. The reason being, maybe sometimes the market leaders have had a good rally and people think that the other stocks which are there in the group might have a good chance of uh, performing well. So based on those kind of rationale, they go and take positions in the laggards in the leading industry group. So it doesn't work always, and people fall trap because those stocks doesn't have a good fundamentals, and even technically it might not be that sound to enter, but then just based on some faulty reasoning they take positions in those stocks. Again, lower priced, lower quality speculative stocks start to lead. As I was mentioning, that people take position in stocks which are not the market leaders, which are not at all the best performing stocks, but then just based on herding behavior, they tend to exhibit herding behavior and go with the go with the go with the crowd. So we should be avoiding these kind of things, because this is again a clear cut indicator of a market top. So the reason behind this is because if the best stocks are not able to lead the market, the stocks which are giving you consistently double digit profit, EPS, sales growth, the fund holdings are increasing. If those kind of stocks are not able to lead the market, and the stocks actually in the same industry which are not at all near to it, the market leader, are suddenly moving up, that calls for a alarm, and you should be worried. It's not a good signal. So if you are invested in those stocks, if you are planning to invest in those stocks, be careful, because those kind of runs will not last for a longer period of time, and you might see a downtrend very soon. So leaders up versus leaders down. If stocks that led the rally are now coming under pressure, it could be a sign that a rally is coming to an end. So this is a chart of IND 47 leaders up and down. So here I would like to add something. In our daily post market commentary, there is a at the end of the commentary there is there are name of few stocks which are leaders up on volume and leaders down on volume. So we give you those stocks, the name of those stocks and the percentage change, so that you can actually get these indicators well in advance, whether which direction the market is moving into. So in up on volume, you have Lumex Industries. In this particular chart, you have these three industries going up as a daily change, and these are the stocks from our IND 47 list, which consist of the top 47 stocks in the Indian markets based on our parameters, the canceling criteria, and it's an algo chart which is generated using computers, and there is no human interference in this chart. So among this chart, which are the stocks which are because it consists of the market leaders, so you get to see if the market leaders are going up, which all the market leaders which are going down. So you will get a rough idea about how is that particular sector performing, and what's in store for those particular industry or sector. So this is an example where we have shown some of the market leaders which are falling when the markets are topping. If you see here, Eicher Motors, again we all know which it's a market leader, and again when the market is into correction, so when the market was in correction, you see the movement of this particular stock. Another example, Asian Paint. In paint, in this industry, Asian Paint is a market leader. So when the market went into correction, leaders. So actually, William O'Neill in his book, he has mentioned that during bear market, even the market leaders, they are also not spared. They also fall very badly. So that is why it's not at all recommended that you go and try to buy stocks during correction when the stock is making a new lows, because we never know where exactly will be that low. You might buy a stock at 50 rupees and suddenly you see the stock, by the end the market condition changes from correction to uptrend to rally. You will see that 50 rupees stock fell till 20, and your capital eroded in a correction, and you again, when the market condition is improving, you don't have the capital to make a comeback. So that is why when the market is in correction, strictly follow the rules, and that time when market leaders are not doing well, then it's a clear cut sign that the laggards, which are temporarily doing good, will not continue its run. So this is the third example is of Page Industries, which is again a market leader in its segment. Britannia Industries, if you see the stock the stock actually was trading just below its 50-day moving average and ultimately went on to breach its 200-day moving average. So this is the kind of fall which happens when the market enters into correction. These are the stocks which normally gives 70, 80, 90% when the market is into it was in rallies, and when the market is into correction, just see the fall. So in October 2016, when the market was almost topping, we all know that post demonetization the market corrected, and during that time we saw a lot of good quality stocks falling down. And though that correction lasted for 2 to 3 months, but then again the market conditions improved. So let's see some of the examples, some of the market leaders during that time. So Asian Paint is a market leader in the paint industry, and when the market was topping, overall market sees and this was the point where the distribution day count warranted for a change in market direction. And after this, the stock started showing the weakness along with the Nifty, and it went into a downtrend. If you see these candles, and suddenly the stock breached its 50 DMA. So during market correction, when the stocks are breaching its 50 DMA, you will not find any kind of a support. When we talk about market support in our previous webinars, we have discussed how fund institutional investors give support at 50 DMA and 200-day moving averages. So during market conditions, all the supports are also lost, and that is why we say that you should be, during correction, it's highly important that you follow the rules. Yeah, so the stock breached its 50-day moving average over here and ultimately went on to make a downtrend. You see this gap when the market was falling and went on to breach its 200-day moving average, and it is warranted, it is supported by the high volume. This is the average line, and it's very much above the average volume. So this shows that funds which actually were supposed to give support at 50-day and 200-day moving average has lost interest in the stock, and they are pulling their money out from that particular stock. So this is a time when the market was also into correction. The Nifty was into correction post demonetization, and this is a stock which is a market leader. So at this particular point of time, you should have a clear-cut idea that this is stock. You should be coming out of this stock, and by this time, I think this stock would have also met a 8% stop loss rule. So consider these rules, follow this sell signals, and you will be able to preserve your capital with us, with our canceling methodology. So as we always mention that when selling and buying the stocks, while shortlisting the stock, fundamentals are very important. It's like 80% fundamentals. But then when buying and selling the stock, the buying point and selling point will be based on technicals. So there that 20% comes into play, and that 20% can sometimes make it or break it, because you might have shortlisted a very good stock, but then if you are entering into that fundamentally good stock at a wrong point of time, you might not get the actual benefit of that stock. So that is why we at MarketSmith India, we follow fundamentals and technicals, and we give importance to technicals because based on technicals, if you're taking positions based on technicals, you get to have the proper run of the stock. You get a share of that run. So when we talk about fundamentals, we talk about earnings and sales growth, return on equity, etc. And for leading stocks are often good when the market tops and stocks begin to fall. So fundamentals are normally very good when the stocks are moving towards their topping, when the stocks are kind of topping out. Because when any stock is moving, the main thing which is driving the stock price is the EPS and sales growth. So obviously, when the stock is topping out, it means nothing but the stock is making a new highs and highs, and that high will that is that the treasure for that is the EPS and sales growth. So when the market is topping and the stock begins to fall, that is a time where you should be checking the technicals as well as fundamentals. You might see that stock has, based on general market distribution, the stock might fall, or you might see some of the quarters the stock the companies reporting below consensus, below estimates earnings, and suddenly the stock starts making a downtrend. So if the distribution days are mounting, we all know distribution day now, when any of the index is falling by 0.2% or more, and the trading volumes are more than the previous day's trading volume, previous trading session. I mean the previous trading days volume. So this calls for a distribution day, and when you see that in Nifty the distribution day count is increasing, and the stock which you are holding is also has also started showing the weakness, that means that you should be coming out. You, based on some other sell signals, you should be coming out of that particular stock. And here there is a term called defensive selling, which means that you are selling the stock, say you have made 20-25% return, or even 15 to 18% return when the market is in uptrend under pressure, or kind of, or getting into a correction. When distribution day count is piling up, you should resort to defensive selling. And we don't want fundamentals to show weakness, because technicals anyways is driving down the stock price. When the stock has moved into a downtrend, the technicals is already weighing down the stock, and once you start seeing the fundamentals weakness, the stock actually tanks. So we don't want that to happen, and we will try to come out of the stock as soon as possible. So at 2016 market top, Asian Paints showed good earnings and sales growth even as its stock price dropped. So that is why we say that buying and selling will be based on technicals, because here when the stock topped out, even then the fundamentals at that particular point of time was very good. But then you see the downtrend. The stock actually went on to fall from 1,227 to 974. The stock fell roughly 20%. So if you would have not identified the weakness somewhat over here, when the stock reached its 50 DMA on high volume, you would have ultimately lost 20 to 25% of your gains. And if you see the fundamentals, from in March 2016, the EPS changed by 23%, sales change was 4%. So it was reasonably good for a paint industry. It was reasonably good. The sales were accelerating, and even the EPS change was kind of into double digit, close to 20%, and it was also good. But then technically what happened, there was an inflection point, there was a trend reversal over here, and ultimately based on technicals, just technically, and also the market direction was not in favor, because market was into correction. So that is why the first thing is market direction. After that, your particular stock, which particular stage it is trading, and after that, if it has made any climax top without any reason, the stock is consistently making all-time highs, or say for example, there is suddenly you see markets falling down back to back 4 to 5 trading sessions on above average volume. All these are weak calls for seeing your stock, watching, and calls for a careful monitoring of your position. So finally, we'll discuss that how you can protect yourself when the market is topping. So the first thing is, it's nothing new. We all know, we have discussed today also, we have discussed in previous webinars also, we have discussed that regardless of market conditions, one sell rule is that sell the stock the moment it hits 7 to 8% below your purchase price. When it's falling down, more than 7 to 8% of below your purchase price, you should be thinking of selling that stock, and sell even sooner if distribution days are mounting and your stocks are showing weakness. Now here a lot of people fall into a trap that seeing that every day distribution day count is increasing, the Nifty is I mean the indexes are very volatile, and Nifty is making new lows and coming, say it's trading more than 5% of its all-time highs. So this kind of things happening and you are seeing this, but then again in these kind of scenarios it's important that you close your position at 5 to 6%. You should not wait for 7-8%, because the market general direction, the general trend is not good, doesn't look good. So in that case you can sell your stock at 5 to 6% also. After that, get off margin, play it safe, and don't compound any losses by staying on margin. So again, this is also very important, because once the market condition changes to correction, and your stock moves into your stock also moves into correction, because most of the stocks which we are recommending are market leaders, and during when the market is into correction, that time the market leaders, they actually fall more compared to other stocks. So you see that over the time that 8% can suddenly become 20%, 30%, because there is no limit as to how the market can fall. Because so that is why don't play it safe and don't compound any losses by staying on margin. And the third important thing is lock in your gains. Now here that defensive selling rule comes into play, where if any of the stock which you are holding is into a rally, you have made good returns, strictly sell it to 20 to 25%, and when suddenly you see distribution day counts piling up and you are sitting at a profit, good profit, decent profit, kindly sell the stock. Because during the early phase of a bear market, certain leading stocks may seem to hold up. So this hold, when the leading stock market leaders are holding during the early phase of a bear market, this is the best time for us to come out. When you're seeing that the distribution day counts are increasing, market status has been changed from rally to uptrend under pressure, and during uptrend under pressure also your uh, distribution days are increasing. So in that case, and your particular stock, the stocks which you are holding, those stocks are holding up, it's moving sideways. So just think that the stock is giving you a chance to sell and come out of the market. So don't be fooled and wait for the stock to again continue that rally, because 3 out of 4 stocks follow the market direction. So the other places where you can spot a market top using our I mean using our app is the daily big picture which we are sending you at around 5:30. You can expect this. You get this daily big picture based on mail, and you also in that daily big picture you in that daily market commentaries we mention. So if you see that today's action will be mentioned, the current outlook, like if you check the today's commentary itself, you will see that market is in confirmed uptrend. And what does it mean? For you as an investor, the market environment is conducive for new purchases, but remain selective. You should be focused on fundamentally strong stocks breaking out of sound base patterns. After that, you should be uh, following a strict discipline and exercise sound buy and sell rules. So you, by reading our daily market commentaries, by checking our homepage, and by and also when there is a change in market status, we do send a teaser also and a notification. So if you're following those things carefully, you will be able to identify the market direction with us. You don't have to do the hard work, because we are doing all the homework for you. So you just have to follow and use our app carefully. So in our next webinar, we will talk about how to spot market bottoms. Like today we discussed how to spot market tops. In our next webinar, we will discuss about the market bottoms. So there we will learn that how to tell when a correction has ended, because after demonetization, when we were very instrumental in letting people know that the correction has ended and market has again entered into confirmed uptrend. So we will discuss how we get to know when the market is again changing its trend from downtrend to uptrend. Then we will talk about some concepts called follow through day, and also what is a and we'll also discuss stalling days there in a bit details. So we would like to take some of the queries if you have, because here we come to end for the today's webinar. Okay, so we have a query from Mr. I mean, the name through which you have registered is SAGA Saga. So the question says that in the current uptrend, none of the blue chip companies have performed well, and how do you say there is a confirmed uptrend? So we are not saying that blue chip companies will perform well during the uptrend. What we are saying is the market leaders. It's not necessary that every company which is every blue chip companies right now is a market leaders. We have to check the market share. We have to check the EPS growth, market capitalization. It changes every day, and just blue chip companies are not a good indicator of the market status. While Nifty is, because Nifty's distribution day count has decreased, and the market has made is the Nifty is making and touching all new highs on a closing basis. So Friday was a time when the market closed at a made a new all-time high on a closing basis. So based on that, the market status changes, and not specifically based on the blue chip companies. So we have some people are asking about the recordings. Yeah, we have. Uh, yes, we have the recording of this particular webinar, and you will get it. You can request for the webinar through mail, or also you can go into our education tab, and in that you will find the link to the blogs and webinars. Yes, you can watch the previous videos also. The question was by Mr. Prashant. You can watch those. Okay, so few people are requesting to explain the distribution day count again. So distribution day count, the definition of distribution day count is when major indexes, say for example Nifty in India, when Nifty is falling by 0.2% or more, and the volumes are higher than the previous day's trading session, then it will be called as a distribution day. And when 4 to 5 distribution day piles up in a trading session of 25 in 25 trading session, and the market has breached its 50-day moving average, or for example market is the market is 4 to 5% below its all-time highs, so this calls for a signal that there might be a trend reversal, and we should be on top of market and should be checking our investment regularly. Uh, no, distribution day is for an index, but I explained that how aligning distribution day counts with the stock price movement, how you can identify the weakness in the stocks. We at MarketSmith, we are not giving short calls or shorting calls right now. So yes, right now we are not thinking about that. Hmm? Okay, so we have a question by Mr. Vikram that since 2007 you have shown three uptrends and three downtrends alert on chart. Just wanted to check if these six were the only alerts during these years. If it gave very selective, few selective alerts, then system is fine. Yeah, see, as I was saying that this distribution day count of 5 and 6, or for example, Nifty coming below 4 to 5% of its all-time highs, or Nifty breaching 50-day moving average. These are not just random numbers. It's based on last 65 years of empirical research by William O'Neill himself. And after testing this in a developed market and emerging economies, we have come up with these numbers. Even this index is falling by 0.2% on higher volume compared to previous day trading session. It's just not a random number. There is a lot of empirical research behind this. So, for example, if you see our product, we launched our beta version in 2016 and officially launched MarketSmith India in 2017 itself in April, in the month of April. So, if you see in 2016, we were very quick in identifying the correction post demonetization, and also after demonetization when the market entered uptrend into confirmed uptrend. That time also we were very quick in giving the buy recommendations. We bought a lot of stocks that time, and actually that helped the investors who were with us, our subscribers, because some of the stocks we added that time, we are sitting at a profit of more than 200%, some of the stocks 150%, and we were the part of that rally. We never missed the rally which was there from the starting of 2017. So we have this, it's a back tested formula, and we have given few, I mean, we have identified few downtrends, and post year after 2016 the market has entered into uptrend and depression, and always it has rebounds to confirmed uptrend. We haven't seen any correction as of now. So no, Nifty has not done any distribution in the last week, but then Nifty has dropped some of the distribution day. Now there is an important concept which is called aging. So aging means when the distribution day count is dropping. So in 25 trading sessions, I mean, every distribution day count gets dropped in 26th trading session. So for example, there was a distribution day count on first, and let's say that every day the market is open, and the 26th trading session is on 26th of that particular month. So the distribution day count which happened on first will be dropped on 26th of that particular month. Here we are assuming that in 26 the market has 26 trading sessions. So ideally what I mean to say is the distribution day count ages in every 25 days, in every 25 trading session. So that is why there was that 20, we have taken that 5 week, and we were saying that 5 to 6 trading sessions are required for market status to get changed. Okay, so we have a question from Mr. Prashant that and also Mr. Krishna, that 7 to 8% is risky as every stock is subjected to such fluctuation. So the based on our empirical research, and also if you are a subscriber with us, if you are noticing the stock recommendations which we are giving, so ideally a good quality canceling stock will not fall more than 8% from its purchase price. And I'm not considering sudden negative news about the stock or sudden change in some, I mean, there is during the Korean tensions we saw that when there were some tensions between North Korea and US, that particular time markets, a lot of stocks fell 7-8% in a day. So I'm not considering those one-off cases, but then incrementally if you see that the stock is falling by more than 7 to 8%, which will not be that easy, because stock after we have observed that a lot of stocks after just hitting 7% or 7.5%, it bounces back. And if it is actually breaching 8%, that means there was some mistake in identifying the stock. Either that was a failed breakout, or some fundamentals were not that great, or there is some weakness in that stock. There was some mistake in identifying that particular stock. So incrementally, the stock, it will take a time, it will take some time for the stock to fall down to 8%. I'm not talking about one-off cases where in a single day you might find the stock falling by 10%, and the other day the stock is again making up for that. Yeah, so if three distribution day count happens in 25 days, so on the 26th day, if the first distribution day count was on the first, so in that case, on 26th day, the distribution day count will be 2, in case there is no addition on the 26th day. Uh, so okay, how we will identify the bottom in our next webinar, we will discuss that how we identify the bottom. Actually, for finding the bottom, it's not reversed, but just a continuation of what is happening. Because once the market enters the uptrend under pressure, any 2-3 distribution day, adding piling on those 5 distribution day, and market further falling from its say 50 DMA or 25 DMA, it calls for a correction. So ideally, it's not reversed, but then addition to those distribution day count, and we will discuss that in the next webinar which we have. So leading stocks are nothing but the stocks the stocks which are the market leaders in their particular industry. So say for example, when we are talking about auto stocks, then we talk about Maruti, or auto components. When we are talking about auto components, then stocks like Motherson, Sumi, Sundaram Fasteners, Minda Industries. So those are the stocks which are market leader, and those are the stocks which in a bull the market leaders outperform its peers, and during market correction the market leaders actually follow the market trend. So there is a query by Mr. Neeraj that please explain this for the futures and options. We have a different product for the futures, for Nifty futures, and in case you are interested, you can send us a mail, and the concerned team will get back to you with the description of that product. No, there is a question by Mr. Himanshu that does this concept of stage apply to index also? No, so indexes will not have this stages, because this stages, you have to check the distribution day counts, you have to check the market status, and then based on that you have to check the index stage for particular stocks. So basically, the thing is you have to align everything and check whether because ultimately what you are concerned about is you are concerned about the stocks which you are holding more than the market. Everyone is concerned about the stocks which they are holding. If my stock is doing well, if my stock is doing well during the downtrend, in that case, you might feel that okay, even if the market is not doing good, at least my stock is doing good, and you will be happy. So the thing is you have to align the market status to the stocks which you are holding. No, distribution day counts cannot be calculated for the specific stocks. It's just for the index, and for particular stocks. I have mentioned. I have explained that what all things you need to see. You need to see the stages in which the stocks are trading. You need to check the climax top. You need to check if the stock is breaching 50-day moving average. You need to check if the stock has reached 7 to 8%, has fallen 7 to 8% from your purchase price. So all those things you need to check for the stock, and what you will check in the market is the market direction. So you will be able to identify 50 DM and 200 day moving average. Is in our app, that red line which is there calls for 50-day moving average. That is the 50-day moving average, and below that there is a line which is 200-day moving average. So we will end the today's webinar here. If you have any further queries, you can email it to us and we will try to get back to you as soon as possible. We hope that you all like the today's webinar. Looking forward for your participation in the upcoming webinar. Thanks a lot for joining. Have a nice day.